In this presentation, we're going to look at an accounts payable, which is a liability on the balance sheet, and we're going to look at its effect on cash, which is an asset on the balance sheet, and also how it affects expenses, which is part of net income in the income statement. Also note that expenses at the end of the year, end of the period, they flow into retained earnings, which is stockholders' equity on the balance sheet. So secondly, let's look here and see what is accounts payable. Well, accounts payable is comprised of some goods or services that we've used during the period. Examples could be utilities, rents, interest on borrowed funds, commissions, and so forth. So let's look at a timeline here. Say we're looking at the period March through October. In this case, we've accrued or incurred an expense in that time period. These expenses are incurred, but they're not yet paid for in cash. And we'd pay for them after we used them at some point in time here, say near the end of the year, we paid for these expenses. What we're trying to do here is we're trying to allocate and match those expenses or services that we've used to the income statement here, the expense account in the income statement. Okay. Let's look at a typical simple transaction here for accounts payable. Say we made some purchases on credit, or we've incurred some utility bills and so forth. So at that point in time, what we would do is we'd increase accounts payable. Say we'd credit it or increase it by $1,000, and then the corresponding entry would be to expenses here. So we'd increase expenses, debit that by $1,000. You just want to note that at the end of the period, this $1,000 is closed out. So by doing that, we would credit or reduce expenses by $1,000. It would actually flow through an intermediate account income summary, but the net effect here would be to reduce retained earnings or debit retained earnings by $1,000. Okay, let's look here that after we've made some payments, or we've paid for some of these expenses or paid some bills where we had some expenses due on some bills for utilities, so forth. So what we do in this case, we'd reduce accounts payable. And here I just show two payments of $500 each. So we would debit accounts payable, reduce accounts payable, and then the corresponding credit entry would be to cash here. We actually use cash, so we decrease cash by two payments for $500 each. So what we're looking at here in accounts payable, when accounts payable increases, we match them here to expenses, which increases, and when accounts payable decreases, or we pay on this account, we also use cash or we decrease cash. So this is just a simple summary of how accounts payable works and interacts with cash and expense.